Hi everyone, this is Pete here. So today we're going to talk about the latest situation that's happening in the UK right now that seems to have rattled both the stock and the bond market. But actually what is happening and can UK be safe? Let's dive straight into it. Just recently the UK has a new government, a new Prime Minister, and she brought in a new Chancellor of the Exchequer, so they call it. Actually, it is the Finance Minister. And it's this guy, his name is Kwar, and he brought in what we call the mini budget, which was not mini at all. So what is in the mini budget? Let me just give you a quick summary and help you understand why the market reacted the way it did. Firstly, he mentioned that there will be a lot of tax cut. Number one, there will be scraping the top 45% income tax for the top earners in the country. And he will also be cutting stamp duty for home purchases. Thirdly, he is cancelling the planned corporate tax increase, which was meant to increase from 19% to 25%. And last but not least, he's going to create more investment zone with tax breaks for good businesses. Now, overall, all these are good for the economy in general because he's trying to spur business growth. In fact, he's also cutting down tax for beer, wine, and cider. Now, the second one is the one that is not so popular, but he has his reasons for it. He basically said that the banker's bonus that was kept since the 2008 global financial crisis will now no longer be kept. His reasoning is that he wants to attract more people to London as the financial hub to really further help to grow the economy. And of course, the last thing that we already know is that there will be an energy cap in terms of how much each household will pay, and this will be capped at 2,500 per household to help people with the rising energy costs. So if that was too much, basically just remember Kwar has only one mission in mind right now, and he is saying we will grow at all costs. Now before we continue, a word from our sponsors, Weibo. Now Weibo just updated their sign-up bonus to the highest ever, where you can receive up to $130 of Tesla shares and a complimentary $10 Grab voucher. All you need to do is to sign up at the link below, fund it with just $2,000, complete one stock or ETF trade and one options trade within 30 days. Voila! You will get the $130 worth of Tesla shares and your Grab voucher. On top of that, Weibo is currently charging zero commission for both US stocks and US options. So if you are active in the US market, do check it out. Now back to the video. Now, all this growth definitely will cost, but how much is needed? So in total, the tax cut will need about 48 billion pounds, and the energy subsidies for the next 6 months will cost around 60 billion pounds. So all these are going to be funded somehow, but if they are not raising taxes, where is the money coming from? Now, the answer to this is debt. So they are planning to sell more bonds into the market. So this is where the market gets a bit worried. People are asking Kwar, are you sure this is the way to do it? Because right now, all over the world, everyone is doing the opposite. Instead of borrowing more, they are tightening their belt, they are raising the interest rate to give the economy a reset. Upon this news, why is the UK bond sold off so sharply? Because people are predicting that UK will issue a lot of such bonds, and the interest rate on all these future bonds are going to be really high. And therefore, existing bond price begin to fall. Now, of course, another thing to take note of is that people are a bit scared that UK will not be able to service this debt. But don't worry, the good thing is that UK prints its own money, right? So I think it is possible for them to finance all this. So is higher bond yield, lower bond prices necessarily a bad thing? Actually not, right? In the long term, is actually a good thing, especially for the pension funds in the UK, because it helps them to harvest more returns for the retiree. But in the short term, all these lower bond prices means that the pension funds need to suddenly come up with more collateral because previously they had hedging strategies. With the bond prices dropping, all this position that was previously hedged needs to be margin called, and guess what? When they are on margin call, they will have to sell something, and in one way is to sell the bonds that they are holding and kick off a vicious cycle of bond selling. Let me show you how this works. So it starts off with the government saying we're going to sell more bonds, giving higher interest rate, but all this money will be used to fund future growth. And the pension fund is saying, no, but this means the bond prices will drop and we will get margin called. And to answer all these margin calls, to meet the calls, they will have to sell more bonds. So it makes the bond prices drop even further, which worries the pensioner. But guess what? Going back full circle, the government is saying, hey, lower bond prices and higher interest rate, great, then I can sell even more bonds. Now, it's not just that the bond prices are low that worries everyone, it's the fact that they're going to borrow a lot more money that gets people concerned. And you can see over here, the people are afraid that UK will not be able to service its debt because the debt has already jumped to an all-time high as opposed to its GDP. So the government is using debt to borrow more money to spur the economy, but the worry on the side is that will they be able to pay it off? Now, frankly, this is not new because we have countries in the past who have borrowed their way out of a crisis, out of a recession, and they definitely lift this directly from the playbook of another country. Now, I wonder which country is that? Now, other than the bond prices dropping, at the same time, the pound is also dropping. Now, of course, there are two reasons why the pound is dropping. First and foremost, because the US dollar is strengthening, but at the same time, the pound on its own is falling because, guess what? They're going to print so much more money into the market, causing the value of the currency to drop. But guess what? A falling currency is actually not great for inflation because a large part of the inflation is due to energy, and energy is mostly oil and gas, which is denominated in US dollars. So to save them all, the Queen Elizabeth rose up and come up with a lot of gold bars to save the country. Okay, no, I mean the Bank of England came in to do something really drastic just yesterday. So this is where the Bank of England panicked and came in because originally, if you look at this, the Bank of England said, which is very much same as the Federal Reserve, that they will raise rates to fight interest rate. But now, with the government saying we're going to grow the economy, actually raising rate is actually bad for growth. Instead, he's saying, I want to borrow more to spur growth. But the Bank of England is telling them, hey, if you borrow more, it's just going to cause higher inflation. So it's kind of like a back and forth. It's like a tug of war kind of scenarios that you see in Squid Game. With three players once again, the Bank of England say, I want lower inflation. But the government saying, we want to grow faster than inflation, not just to lower the inflation. And guess who is in the middle? The people. But ultimately, the Bank of England gave in and basically came in and say, in order to make sure that the bond prices do not fall further, they committed to buy 65 billion pounds of UK bond in the next 13 days in order to restore the price of the UK bonds. So basically, they are doing the same thing as what the US have done before, just that this time round, it is the Bank of England doing it. With the Bank of England stepping in, you can see that the government bond yield, now remember yield is inversely correlated to bond prices. So as the bond price dropped, the yield kept rising. But with the Bank of England coming in, it has since really come down on the market quite a fair bit. But it is still much higher than what the bond yield were in September. So with so much QE happening, the pound prices naturally fall. But while the lower pound price is actually good for growth as it allows further export, but remember, the reverse is also true. The import is going to cost a lot more, and likely the cost of goods of all this import stuff is going to lead to a higher inflation. In fact, this has attracted so much attention that even the IMF, which seldom give such a strong statement, has come out to strongly criticize the UK policy. So at the end of the day, could the UK government be correct that a spending spree will be enough to spur growth to save the economy from a recession? Or will the Jerome Powell method of lowering inflation at all costs work, right? Who is correct? Honestly, only time will tell. Why? Because both scenarios has happened and have seen success before. The UK did spend their way out of the last recession in 2008, and they have also allowed a crash landing in the 1970s to save the whole market from running inflation. So what does this mean for the market is that it's going to be a lot more volatility out there, but for those of you who are investing properly and you understand how to invest, this is where prices can get really cheap, right? Especially great companies that are doing really well. So I'm going to cast my sight into the UK to understand, hey, which are the companies out there that are doing fantastic, right? So guys, if you find this useful, you like the content, do like and subscribe, and I'll see you guys next time. Bye bye.